Brad Williams, Frugal Finance, nominal interest versus real interest rates on bonds. I've discussed this briefly in other courses. This will be a quick reminder for some of you. For the newbies, the nominal interest rate on a bond is the promised amount of money you receive per unit you lend. The real rate of return is defined as the nominal interest you earn corrected for the change in the purchase power of money. For example, if you earn a nominal interest rate of 8% per year and the rate of inflation is 5% per year, then the real rate of return is 8 minus 5 equals 3. Well, no, we already know that in order to do this, you have to take the nominal divided by the real in order to get the spread, the actual change. The difference between the two is your inflation factors. The general formula relating the real rate of interest to the nominal rate of interest and the rate of inflation is 1 plus real interest rates equals 1 plus nominal divided by the rate of inflation. So, or real interest rate equals nominal interest minus rate of inflation divided by 1 plus rate of inflation. 108 minus 105 divided by 105 equals 2.857 right here. What does this mean? If inflation stayed at 2.857 for the next 45 years, how much would you need in order to buy the same $100 worth of goods in 45 years? I plus 0.02857 times 45 equals 355. So in other words, annual, it's $355 at 2.857. Over 45 years, $3,192. That's a chunk of money. Price level in 45 years is equal to 8.985. And this should be nominal future value divided by future value price level. The balance sheet. Some of you might not be up to date on balance sheet, income statement, cash flow. So here's a quick, minute and a half in terms of what the heck a balance sheet is. A firm's balance sheet shows its assets, what it owns, and its liability, what it owes, as a point of time. The difference between a company's assets and liability is its net worth, also called owner's equity. For a corporation, net worth is called stockholders' equity. The income statement. The income statement summarizes the profitability of the firm over a period of time, in this case, a year. Income, profit, and earnings all mean the same thing. Difference between revenues and expenses. Typically, company expenses are broken down into 4 categories. The first is the cost of goods sold. This is the expense that a company incurred in producing the products and services it's selling during the year, and includes the materials and labor used to manufacture them. The difference between sales or revenues and cost of goods sold is called gross margins. The second expense category is general, administrative, and selling, SG&A. These represent the expenses incurred managing the firm, such as the salaries of the managers, and in marketing and distributing the products produced during the year. The difference between gross margins and GS&A is called operating income. Third category of expenses is interest expense of the company's debt. Fourth expense is the company's tax liability. Cash flow statement. Every dollar that comes into and goes out of the business on a quarterly or annual basis is shown in the statement of cash flows. It is not the same as the income statement, which displays the company's earnings and outlays. For 2 main reasons, the cash flow statement is a useful addition to the income statement. First of all, it draws attention to the company's cash position over time, which is crucial because cash flow problems can arise in even extremely profitable businesses. Managers of the company and outside observers can determine whether the company is building or losing cash reserves by keeping an eye on the cash flow statement and understanding the underlying trends. For example, it is not unusual for profitable and quickly growing companies to struggle to meet their financial obligations due to cash shortages. In contrast to the income statement, the cash flow statement offers insightful information by avoiding the subjective decisions made during recognition of revenue and expenses. Since accrual accounting techniques are used in the income statement, not all revenue is converted into cash inflows, and not all expenses are paid for with cash receipts. Various managerial decisions about inventory valuation, asset depreciation rates, and intangible asset amortization impact a company's reported net income. As an illustration, these accrual accounting decisions have no bearing on the cash flow statement. The effect of these accounting decisions can thus be ascertained by contrasting company's cash flow statement and income statement. Brad Williams, Frugal Finance. See you soon.